you very much, Ayu. And it's a tall order to come after a panel like that, but we are going to excel, I'm sure. Let me start by saying that this is going to be the last session at this two-day conference, and by magic, it all's going to come together at the end, so don't go anywhere. But before we get to that, I have lined up a very interesting topic for us to discuss. We have heard about the need for innovation. As economists or in technology, we believe that competition is a good thing. But we also, as part of the public sector, and most of us actually think that financial stability is a good thing. And striking the right balance between these three objectives is really hard. We're going to frame this discussion around the fact that big techs are very interested in getting into financial services, and they are setting the stage in many different ways when it comes to how we as individuals access digital services and development of digital services. And just to give you a little bit of a warm-up, and why I think Benoit is the perfect guest to discuss this, is that some years ago in 2021, the European Union proposed a Digital Markets Act in order to sort of control the online gatekeepers, like the big techs, making sure that the problems of high barriers to entry and anti-competitive practices by designated gatekeepers were kept at bay. And the objective, obviously, is to make digital markets both contestable and fair for existing and future rivals. And there is a lot of details in this act that we could get into. But I think it's perfect to have you here, Benoit, because you are now the president of the French Competition Authority, but Benoit has a very distinguished career. He served the French government in various domains. He spent 8 years at the European Central Bank as member of the Executive Board, but you also chair the CPMI, the Committee for Payments and Market Infrastructure, here at the BIS, who set a lot of the rules that we are all kind of been discussing in different areas. You were very interested in early time digitization of payment systems, rise of crypto assets, etc. And it's great for us at the staff to have you back here. So let me start with a kind of perhaps more personal question. You were there when this hub took its first steps 3 years ago. How has it played out, you think, as expected? What have we missed? And do you have any thoughts about our way going forward?
Thank you, Cecilia, and thank you very much for having me here today and over these 2 days where I've learned a lot, and it has been an incredible experience to reconnect with all former colleagues at the hub and also in the BIS membership, and also to kind of take stock of how much the BIS Innovation Hub has achieved so far, but including over the last year since I left. So I'm kind of both proud of what has been achieved since the hub has started, but also humbled by everything that has been achieved since I left. And it's a lot, and it's a tribute to your leadership, Cecilia, and also to Ross Leco's leadership here in Basel. So it never turns out as expected, which is the whole point of being agile, and that's why the hub has to remain agile, because it hasn't turned as expected, it won't turn as expected, and it's okay. If I may, kind of draw maybe some lessons or tentative conclusions for the future, if you allow me, Cecilia.
Fire away.
I think the first kind of overarching conclusion for not that much for you and for the hub, but more for BIS membership and for the BIS as an institution, is that that experience has been a success, which wasn't for granted. I think it's Sunaina on the previous panel who said innovating in a central bank is a little bit like an oxymoron. Someone who's been very close to the whole process and whom I've been talking to yesterday here in Basel told me, look, innovating in a central bank, it's like driving a car on the highway, but they ask you to keep your foot on the brake. And so the whole thing is about, making people comfortable with speed and having people trust you. And so my lesson for BIS governors is you can see how much the hub has achieved now. So you should just trust them. They are talented, incredible people. They have the right framework also in terms of risk management, of course, procurement, money, and so on. And that's very important. But don't try to micromanage. I mean, just trust their ideas and their capacity to ideate, to innovate, and you'll be very well served. So that's my first lesson. The BIS Innovation Hub might have been the most consequential change in at the BIS in its 90+ years story. It's too early to conclude, but it has been working very well. So that's the first conclusion, and maybe 3 kind of more pointed conclusions for the future. So that's maybe more for you, Cecilia, if I may. I think it's pretty clear that you will have to evolve your priorities over time. You said it in your opening statement. The focus, the strategic priorities or focus areas will change. I'm pretty sure that over time that will evolve from the current focus on payments and CBDC, which is very much the bulk of what the BISIH has been doing and is still doing. I'm pretty sure that AI and ML will take an increasing role, and we've heard about it yesterday and today, and that's going to keep changing. Second conclusion is you might have to kind of broaden the range of stakeholders you're talking to. We've heard a lot yesterday and today about privacy, about money laundering, about, competition, obviously, and we can go deeper into it. Liaising with securities regulators, with privacy regulators, with governments will be incredibly useful. And if I may, also liaising, talking with the private sector, because attitudes towards innovations can be different in different places. I mean, one of the lessons I've learned here is about different attitudes by different banking industries in different places. If you take CBDC, for instance, the European banks have been incredibly hostile to CBDC, and they still are. So there is a basic kind of fear of innovation in that field. They see CBDC as a threat, retail CBDC at least. While Asian banks have been much more, forward-looking and forward-leaning and seeing CBDC as an opportunity to create new services and to reach out to new clients. And the BIS is uniquely placed to kind of, blend these different cultures also with the private sector. And maybe the last conclusion is that might be for the BIS membership is that at the end, the proof of the eating is in the pudding. So all what you're doing here will be only worth what central banks will do out of it. And so at some point they need to put their money where their mouth is and to just, take all these fantastic projects and use them in their operations. And that will be the ultimate proof of success. So that includes CBDC, that includes Rio, Nexus, and so on. So we're not yet at the end of that process, of that life cycle, so to speak. And there is a lot to do also within the participating central banks, not only in the hub.
Mm-hmm. Okay, trivial stuff, all of it. But thank you very much. I have to take note. Let's talk about your new day job then. Mm-hmm. And trying to find the right balance, innovation, competition, and financial stability. Let's assume that we are successful in make sure it's competitive. And that means probably open up for new kind of players, possibly. Mm-hmm. Complex set of players, it could be. So how do you think around those things in your new job? Making sure that we have innovation, competition, but financial stability. Is there a golden rule here?
Well, I like very much the way you're framing the discussion in terms of these three objectives. And I think we should try not to think as economists here, because economists are very fond of impossible trinities, right? Mm-hmm. So the question will be, which objective should you drop? Because you can't have both. You won't achieve the three of them. I think we can and should achieve the three of them. So find ways to reconcile innovation, competition, and financial stability. It's also very important that you, particularly today, I think it's very timely that you're stressing financial stability. Regulators sometimes tend to forget that financial stability is part of their DNA, and so there are kind of cycles in regulation, and sometimes they forget, and they kind of, they want to give some breathing space to the industry, and it always ends very badly. So I think we're at a time where that lesson is easy to understand around us. So how do we achieve that? I think if you take innovation and competition, for me that's pretty much a no-brainer. That is the essence of antitrust and merger control is to create conditions where newcomers can come in to allow incumbents to be challenged. That's the essence of what I'm doing in all industries. And when big players kind of try to argue that competition is bad for innovation, that's a fig leaf they're using to make their case and to try to foreclose their competitors. So for me, that's really a no-brainer. And I'm totally confident that innovation and competition are kind of mutually supportive, reinforcing. Competition and financial stability, it's a little bit more of a more complex story. I mean, the relationship between central bankers and antitrust enforcers has been a complex one. I mean, I guess some of us in the room remember the 2013 banking communication in the EU, which had the first version of the bail-in rules. And that came from antitrust. Didn't come from the central bank community. And lots of central bankers were up in arms against it and fearing that this would be bad for financial stability. And they were wrong. So that's a kind of complicated history, right? I think it's getting better now because competition enforcers and central banks are now much better aligned on one issue, which is how to deal with big players for different reasons, but their interests are aligned. Competition authorities don't like size because of market power, which allows companies to basically to set prices above marginal cost, and that's bad for the consumer, and sometimes also bad for the suppliers. And central bankers and financial regulators, banking supervisors now are afraid of too big to fail. That's relatively new, but that has very much aligned, the objectives when it comes to the biggest players. Where the interests are less aligned, I would say, but that's my personal view, is when it comes to smaller players. Well, the competition crowd loves smaller players because they see them as, challenging the incumbents and shaking up the market for the good, while financial regulators are always a little bit kind of afraid of smaller players, maybe undermining the standards or potentially mis-selling products, etc. And you can see how the discussion on sandboxes has evolved in Europe, for instance. Lots of regulators are afraid of sandboxes, actually, because they see it as, creating an unequal playing field between the small players and the bigger players. So here, I think that's an area where we can learn from each other, because we have different experiences and different cases.
Do you, if you're looking at, you are running an authority and legislators are for others to decide on, but do you think about the current regulatory framework, how it's sort of balancing innovation inducing versus innovation constraining, taking all these things into consideration? Yeah. I mean, are you happy as it is? Do you see any kind of openings for improvements? And is there any particular example in this area you have in mind?
Yeah. Well,
what does your colleagues across other competitive authorities think about this? What's kind of, how is the discussion evolving between you?
Well, as I said, I mean, there might be a different perspective here in the competition community and in the financial regulatory community. The competition community usually doesn't see innovation as a threat, while innovation in finance can be a threat, and we've seen that. I mean, repeatedly, we've seen instances where innovation has proven bad for investors and bad for the taxpayer eventually. So these are different kind of experiences. My take would still be that the burden of proof should be on showing that innovation is bad, because if you start the conversation by from a place where you think that innovation is bad, you're not going to go anywhere, and you're pretty sure that this will be bad at the end, also at the macro level in terms of productivity and the ability of the economy as a whole to create value. So the burden of proof should be on showing that innovation is bad, and sometimes it's pretty obvious. I mean, look at all the discussion on crypto. I think it's the central banking community has pretty early on kind of set its mind on the conclusion that unbacked crypto was bad for the investor and maybe bad for financial stability, and moved to discussion on stable coins and CBDC and so on. So that's a case where you have pretty, clear evidence. But otherwise, you shouldn't start from the point where innovation is bad. Otherwise, you're sure you're not going to go anywhere. Now, you've mentioned innovation-inducing regulation. I mean, honestly, I'm not sure that regulation can be innovation-inducing, because innovation has to start from the private sector. It has to start inside companies. It's not for regulators to create that. But I would use a slightly different term. I'm pretty sure at the end we'll agree. But what I would say innovation-enabling regulation. And that's pretty much what has been discussed today in terms of foundational infrastructures. So digital identity is an obvious case where you need a regulatory framework, you need public initiative if you want an open finance stack to be possible. AI, ML is increasingly in the focus, where you will need some kind of regulation, ethical regulation, competition regulation, privacy regulation to make it happen in a way that's acceptable by society. So you need this kind of innovation enabling regulation, and because if you don't do it, then the private sector will do it, and you're not going to like the outcome. It's because we're talking of industries where you have very strong increasing returns to scale, network effects. And if the public sector, if authorities don't take the lead in setting the scene will be set by private players, and they will inevitably try to build their walled gardens and to lock in their consumers and to foreclose their competitors, to tie their products, and that's my daily life as a competition enforcer, trying to identify that and to curb it, or sometimes to sanction it. And in many cases, it's too late, because we've let all these big animals thrive, big digital platforms, and it's too late. So if you want to enable innovation in a way that is open, you need the public sector to step in and lay the foundations, and that's very much what has been done, say by Singapore or by India, in terms of digital identity. We've heard about it, and there are lessons to be learned also in other regions.
Okay, and one last question. Big techs partnering up with traditional finance service providers. Are such partnerships beneficial for competition? And it's sufficient to say yes or no.
Depends. It depends.
It depends. Yeah. There's the economist coming out. I'm still
an economist, I think it depends. I would say we haven't really tested it so far, because so far what we've seen is we've seen big techs venturing into finance, testing the waters, but I would say at the margin of the system, because that's mostly about big platforms providing payment services, right? I'm not giving names, but you all have them on your mobile phones, on your smartphones. And that is big techs in finance, but at the margin of the system, right? And when one particular gatekeeper decided to step in the middle of the system, and that was obviously Facebook with Libra, and that was a promise to kind of to change the whole structure, to disintermediate the whole banking system and maybe also central banks at some point, and that has ended badly. So far we're still at this stage where you have kind of skirmishes, at the margin between big techs and banks, but not at the center of the system. And when they tried at the center, it didn't work. Why did it not work? Because not that much because of competition. I mean, you didn't see the DOJ or FTC or the Comco here in Switzerland taking action against Facebook for on Libra. That was the financial regulatory community being afraid, I think, mostly of liquidity fragmentation, of kind of trapping liquidity, global liquidity into closed ecosystems, walled gardens, which would have impaired very much the functioning of the global financial system. And so here again, you have an alignment between competition authorities and central bankers. Competition authorities don't like walled gardens because that's bad for the level playing field, and that's bad for competitors and for clients. And central banks don't like walled gardens because that's bad for liquidity, and that's bad for the singleness of money, if you want, the singleness of M1, and the fact that M1 has to remain backed by M0, to put it in a kind of nerdish terms. But that was the essence of the discussion on Libra. And here again, interests were aligned, and that's where we are. That's where we are. So we'll see if that changes, but I wouldn't expect it to change too much. I think it's going to remain at the margin of the system.
I think in the years to come, among many interesting conversations, will be also the conversation between competitive authorities and central banks on how to get things as right as we can.
I agree, and there will be another important discussion, which we're not discussing today, which is on the role of profits and margins in sustaining inflation. The profit price. Do we have a profit price loop? Do we have greedflation, as it's sometimes called? And that's another important discussion where antitrust and central banking can meet.
Thank you very much, Benoit. It's been a fascinating conversation, and I'm really happy that you made the time to come back to us. So in the interest of honoring the time, I think we were supposed to stop about now. I'm going to make a daunting task and try to summarize some of the things I've heard over these 2 days. And this is not comprehensive in any way, so bear with me. But here we go. As technology improves, central banks need to innovate to make sure that they continue to deliver on their monetary and financial stability. It gets more exciting than this, I promise. Retail CBDCs could be seen as cash plus. It's about protecting integrity, inclusion, and resilience, protecting the singleness of money. And providing money and payments are a public-private partnership, so this is not a one institution show. And whatever we do to change things, to improve, the requiring things are to be covered by appropriate legislations and cyber protections. And in the discussion, the perennial discussion, I think, about central versus distributed technology, from the cybersecurity perspective, there are pros and cons here, and not a simple design choice, but you have to design accordingly with your choices. When it comes to legislation, I took up that the conversation around that needs much more transparency. And the right to privacy is super essential. It's about protecting people's integrity, protecting minorities, being protected against violations of different kinds. And I believe thoroughly in that we need to reach out for those sort of stakeholders much more. Payments, when it's longer than a 30-minute delivery, this is mostly due to AML and capital flow regulations. And here is one of my mantras: tech can take us part of the way, but to get real improvements, you need to do work in regulations and governance as well. We had 2 panels on artificial intelligence. AI needs to go from black boxes to glass boxes, and implementing responsible AI will increase trust and competitiveness. I'm getting soon ready. When it comes to the green transition, the climate transition, standardized disclosure is important. We are a bit proud at the BIS Innovation Hub for the Genesis project, the tokenized green bond, seeing the light of day in Hong Kong as we speak. And maintaining privacy while delivering on the roles of and the rules of anti-money laundering and anti-finance terrorism. Can technology solve both these things? The answer is yes, but more work needs to be done. And about money laundering, approximately 2 to 5% in terms of values of global GDP is laundered, and this is feeding corruption and other types of crimes. And the project Aurora is a network-centric approach using machine learning, trying to tracking suspicious networks, make it possible to spot the irregularities without violating national data legislations. To be continued on that one. And the second to last panel, really an ambitious agenda to progress technical innovation at central banks. I'm going to steal Sunaina's, I think it was 5 principles on innovation. It has to be evergreen. It needs objectives and key results to provide structure. It is a team sport. We need to not only go for perfection, I say as an old central banker, but we need to progress, and that's a key thing. And once we have created value, get it out of the door. And that finalizes this Innovation Summit 2023. Thank you very much for participating.